Hey guys, so today I'm going to go through inventory and cost of sales. By the end of this lesson, you should be able to know what inventory is, cost of sales is, how they fit in with the profit or loss and balance sheet, and also how you account for them. So inventory, you can account for them 3 different types of ways. I'm going to go through that as part of the lesson. So firstly, what is inventory? So inventory can also be called stock. This is something that sits within your current asset section of your balance sheet, and it's equivalent to the value of all the items, costs that you have yet to sell as part of your business. So for instance, if you have 10 cars in stock, that means 10 cars that you're yet to sell, and each car cost you £10,000 to buy and manufacture, then the value of your inventory would be £100,000. So that's £10,000 per car times the 10 units. So what is cost of sales? So these are the direct costs attributable to making a sale. One of the large components of this is the value of inventory that's been released to your profit and loss account. If you were to sell a car for £20,000 each, and each car costs £10,000 to manufacture and buy, then the direct cost attributable to that one sale would be £10,000. That's the value of your inventory being released into your profit and loss account. So your cost of sales balance sits directly beneath your revenue on your profit or loss account. If you were to take your revenue and reduce it by your cost of sales, you arrive at your gross profit. So there are 3 ways that you account for revenue. There's the FIFO method, the LIFO method, and the weighted average cost method. The reason we need to use these 3 types of method is you need to understand what cost you attribute to each sale. You don't buy stock at one specific price or any set point in time. As you're running your business, the price that you're buying all the raw materials at can change over time. You need a method of working out, well, how much do I attribute to each sale? So when using the first in, first out method, the cost you attribute to each sale would be the value of the first item you bought as part of your stock. So you would look at your inventory listing, look at the oldest amount of stock that you have, and whatever that price is, that's the cost of sales that you attribute to each sale. The last in, first out method, or the LIFO method, is the other way around. At this point, you look at the newest amount of stock on your inventory listing, and that's the value that you attribute to the sale. And the weighted average cost method is where you look at every item of stock, you take an average price, and then that's the unit price that you attribute to each sale. So now I'm going to go over some examples to make it a little bit more clear. So with the FIFO method, say you have 300 units of stock. You bought 100 units in January for £1, 100 units in February for £1.50, and in March you bought 100 units for £2. So using the FIFO method, if you had 300 units of stock still left in your inventory, then the first 100 units you would attribute to that sale would be £100. The next 100 units would be £150 to your cost of sales. So the next example I'm going to go over is the LIFO method, which is the complete opposite of the FIFO method. So here we have the same number of units, the 300 units, at the same unit price. So in this example, say I was to sell 50 units in April. Well, you would have to sell the 50 units at the last available price that you purchased the inventory at. So the cost of sales would be £100. That's the 50 units multiplied by the £2 price. Then you were to sell in May another 100 units. Well, you have 250 units left in stock. So 50 units would be at the £2 price. So that'd be £100, and the next 50 units would be at the £1.50 price, which is the next newest available price. So that would be £75. So your cost of sales in May would be £125. The next method is the weighted average cost method. So in this example, we have the same amount of units, the 300 units, and the total inventory value is £450. So you then have to calculate what the weighted average cost is. So in this example, it was £1.50. So that's the £450 total inventory cost divided by your 300 units. So now say in April you sold 100 units, while the cost of sales would be 100 multiplied by your £1.50, which is the average price of all the units. So the amount of cost of sales that you would attribute to your 100 unit sale would be £150. Say the next month you were to sell 50 units, well, the average price would still be £1.50. So you do 50 multiplied by £1.50, which is £75. The next month, therefore, it would be £75 within your cost of sales. So I'm now going to go over the transaction flow when you're purchasing inventory. So say you were to buy t-shirts in their raw form. When you make this purchase, you would therefore increase your inventory position within your current assets, and you would reduce your cash position within your current assets. So it would all be a transaction that happens on your balance sheet. Then, when a sale is to occur, you would reduce your inventory using the method that we just previously described, depending on which one you chose as part of your business. And you would increase the cost of sales or the charge within your profit and loss account. So I'll now go through the T accounts that you need to use as part of the transaction flow that I've just described. So I bring up a cash T account and an inventory T account. And now if I was to buy some stock, I would buy 100 units, say in January, for £100. So I credit my cash account and I debit my inventory £100. Then in February, I buy another 100 units, but this time at £2 per unit. Well, I credit my cash by £200 and I debit my inventory by £200. And there you can see below I've put, using the weighted average cost method, you'd have 200 units at £1.50 per unit. Now, when you account for the cost of sales using the weighted average cost method, say you were to sell 50 units, well, you have to sell 50 units at the weighted average price of £1.50 per unit. So you credit your inventory by £75 and you debit to increase your cost of sales by £75. Using the FIFO method, the first in, first out method, you would effectively sell each unit at £1 per unit, because in January you bought 100 units at £100. That's a unit price of £1 per unit. So if you were to use the FIFO method, you would credit your inventory to reduce your current asset position by £50, and you would debit your cost of sales by £50 to increase the expense position on your profit and loss account. Now, if you were to use the LIFO method, it would be the opposite of this, which is to credit at the £2 per unit price first, because that was the last available price that you purchased the inventory at. Now, to expand the example, if I was to sell another 100 units using the FIFO method, well, this time I would credit my inventory by £150. So that would mean I had sold 50 units at the £1 per unit price, and then I sold another 50 units at the £2 per unit price, which equals the £150. So I've credited my inventory account by £150 and I've debited my cost of sales by £150. And then as you can see below, I have 50 units remaining at £100 or £2 per unit. I'm now going to go over some inventory controls. So I worked as an auditor for a number of years, and there are a number of controls that you want to put in place in order to keep track of how much inventory stock you have available. So the first way is to use stock counts. So this would be every month or every quarter you want to go around and recount the number of stock and to assure that it's the same amount that you have within your records. You also want to be using purchase orders. So when someone requests a purchase, you raise a purchase order to say that they've put in a request. Then when you sell the goods, you want to be using delivery notes to keep track of the number of units that are leaving your warehouse. And then you also want to be using invoices, which also allocate how many units are being sold. Then at the end of each sale, when the sale's complete, you want to match all three of these. So use a common ID code in order to be able to match the purchase order to the delivery note to the invoice. And that way you can keep track of the number of units that are leaving and how much you've been able to sell. And then you also obviously want physical security on your site in order to protect from any theft or any other sort of physical issues that might occur as part of maintaining the level of inventory you have within your premises. And that's it. So now you should know what inventory is, what cost of sales is, how to transact for it, the 3 different types of inventory recognition, and some controls around keeping your inventory secure. Hopefully that has been helpful. If you want any more accounting advice or help, then please subscribe and like this video. Thank you very much.